Like it's Ray Dalio's quote, cash is trash. Well, why is cash trash? Well, if the money supply is expanding at 7% a year, then the risk-free hurdle rate is 7%. If you don't generate more than 7% yield on your cash, then it's devaluing. So from 2010 to 2020, the money supply expanded at 7%. So all the cash you're holding is losing 7% of its value. Assume you have a 0% interest rate or zero yield on the cash. So you can imagine the traditional world, you invest your cash at 3% treasury yields and you get a -7 and it's like a -4% and divide 4 into 72. And somewhere 15, 20 years out, you're going to lose half of the shareholder value in the treasury. If you do that, people might hold their nose. But after March of 2000, the money supply is expanding at 24%, the interest rate's zero. So now you have to put a forecast in place. At what rate will the money supply expand? If it expands at 20% a year and you're going to generate zero in treasury yield, then you're looking at cutting your treasury purchasing power in half in 3.5 years.
Whoa.
Okay, now that's not trivial. So you have to find a way if you're gonna have assets to get over the hurdle rate. Another way to say it is, I have to invest it in a strategy which is going to appreciate faster than the money is devalued. If the money is devalued at 7% a year, then the S&P 500 index better yield 9 or 10%. If it yields 10% and the money devalues at 7%, you're +3. You can save money in an S&P 500 index fund. You can't save money with bonds unless you're buying bonds and the interest rates keep getting reduced. If you bought a bond at 4% yield and the interest rate got taken down to 3.5%, the bond trades up. And when the interest rate goes down to 3, it trades up again. And when it goes down to 2.5, it trades up again. When the bond rates or the LIBOR, the short-term bond rate and interest rate goes to 0, you can't take it down anymore. So bonds won't hold value either. So now you're in a conundrum. I have a lot of assets, but I'm not beating the hurdle rate, and the hurdle just tripled. This is the problem that a company that's cash rich has, and it's a problem that anybody that works for a salary has, which is I generate a cash and the currency is being devalued every year. The real question is, what's the rate at which it's devalued? And let's do the thought experiment. What if we didn't print any more money? What if the inflation rate, the monetary inflation rate, not the CPI, but what if the money expansion rate was 0? In that case, the currency is also an asset and it's a store of value and a medium of exchange at the same time. That's a complete Austrian economics, like deflationary economy where we call it hard money or sound money. The closest thing to that would be the gold standard. If the government said you can exchange your money for gold at any time and we'll keep gold equal to the amount of money and we won't print any more money, well, that puts you on a hard money standard. In that case, you could just store your money in a bank and it would be more valuable in the future, not less valuable. When the government goes off the gold standard, and we went off the gold standard explicitly in 1971, now the currency is losing some percent of its purchasing power every year because it's being inflated away. And what's the number? Well, it was about 7% a year, and now it's like 20% a year, and 15 to 20% a year. And you got to figure out, is it 15, 20, or 25? But if it's 15 to 20, the currency is weakening 1 to 2% a month. When it gets to be 40 to 50, it's collapsing. That's Argentina, or worse. So you've either got a country where the currency is weakening or a country where the currency is collapsing.